this is a post-trade example um, because it drives three main things. This is an intraday chart that looks at how much we sold and bought every 10 minutes, as well as what the portfolios did and the overall cost. I'm not going to get into the nuts and bolts really of what this chart is, but I think this shows kind of the level of the detail that a provider should be giving, so that the post-trade cost result is understood. And also from this standpoint, we can actually work backwards into later the discussion will be how a provider should attack a pre-trade analysis. So from this, the three main things that should be able to be known, understood, are really the one, what is the benchmark? Two, did the provider actually do what they said they were going to do? And the answer can be no, because we all know that the markets are living, breathing, active environments. So there should be some adaptation relative to a strategy. But the fact is, if something was changed, then there should be probably some communication of that throughout the actual trading of the event. So none of this should be a surprise. And then three, do you see evidence of trade execution with some sort of thought that controls risk, or was this result simply due to lazy trading or making some big bets that ultimately as a transition manager, we're not really supposed to be doing? Our job is to control risk. Was the result basically just because of market movement and chance? So this ultimately is really the starting point to understanding and assessing performance in our opinion. You can always drill down into the individual names from there, but ultimately I think from a client and consultant standpoint, it's always starting at that 30,000 foot view. And can you see actually some resemblance of the strategy that we said we were going to do in the actual results and the data?